Alright, today we're going to be looking at Bloom Energy, ticker symbol BE. As always, quick company rundown. So the stock was trading at $215 a share as at the 17th of July. There's 284 million shares in issue, giving it a market cap then of $61 billion. The company had around $2.5 billion in cash and about $2.7 billion in debt, giving an enterprise value of again around $61 billion. So quick disclosure, in this video we're not going to go through everything just because the videos get too long. Instead, what we're going to do is highlight the main points around what I would call the trade thesis and basically like a trade analysis, rather than my more typical videos you'll see on the channel, which are more, I guess, stock analysis and kind of analyzing a company top down all the way through and all the financials and things like that. Quick company brief overview then for anyone who's not heard of Bloom Energy. I'll be very surprised if you're into like stocks and you haven't heard of Bloom Energy, but effectively it's the manufacturer of solid oxide fuel cells, SOFC for short, and effectively what this is a modular combustion-free power plant that converts natural gas, biogas or hydrogen into on-site electricity. And the reason this is so important, and I guess the reason why the stock's been so popular the last year, is because the company's effectively repositioned itself as a clean energy niche player to now kind of being really core to what we would call time to power for these AI data centers and the AI data center build out across the whole of the United States. But yeah, I guess because they've been linked with the AI data center build out, which of course is probably the highest capex spend we've ever seen in basically human history, it's effectively resulted in the stock being up 2,000% in the last 2 years. And in June 2026, the stock peaked at a market cap of around $100 billion. And so I've also made a point here then. So just recently, on the 8th of July, short seller Hunterbrook Media effectively published an article called Bloom's Big Lie, where they effectively allege that the company's no China scandium supply chain claims are false, and that the 5 gigawatt production ramp underpinning the valuation is actually physically unattainable and basically not possible given the current supply constraints around scandium. So for anyone who doesn't know, scandium is effectively just a raw earth metal, and it's really key and vital as far as we know in the production of the modular fuel cells, although the efficiencies and how much scandium they need per module and things like that we actually not too aware of and too familiar with. And then yeah, of course in this section then I kind of elaborate more on the point of why the company's become so instrumental and so important in the current US AI data center build out. It's grid independent, and so rather it can bring power onto the AI data centers within months rather than say 4 to 7 years that we typically see with traditional utility interconnect companies. And then in terms of growth then I've also mentioned here, so between 2001 and 2024 they had 1.4 gigawatts deployed cumulatively. So over 23 years, it took them 23 years to deploy 1.4 gigawatts. And then in 2026 alone, they're planning to deploy another 1 gigawatt, and then Wall Street then have them ramping up to around 5 gigawatts of energy by 2030. So massive exponential growth. And then as you'll see in the short report, which also again I recommend you read in, I guess there's contestation that if this is even possible, both again due to scandium supply shortages. So I've also mentioned here then Bloom describes itself as the world's largest scandium consumer. And then of course again, if you look into scandium itself, China effectively controls most of the refined supply. I believe it's about 80-90%. So if Bloom self-describes themselves as the world's largest consumer of scandium, but then China effectively has a monopoly over the rare earth metal, if you, I guess, put 2 and 2 together, there's obviously a clear supply linkage between China and Bloom Energy. And the fact that the company's been effectively, what you could say, lying about it does raise some concerns and red flags. But as I mentioned, I won't really go into the financials specifically in terms of the numbers like I normally do, just because again it's not too important here. We'll get into that in the fair value price targets where we'll talk a bit about it. Again, we're not going to go too much into sector and competitor analysis. Again, if you watch any of the other videos, I do go quite in depth and talk a lot about the sector comps and competition, as it's probably one of the most important things when analysing a stock, either to trade it or invest in the company. In this case, if you kind of look into it, Bloom Energy are effectively the only real scaled, at least, supplier of SOFC. Effectively, the two main themes really at play here then is if you're a bull, you believe in the AI capex supercycle and the fact that Bloom Energy will play a massive part in it. And then on the bear side, follow Hunterbrook and a lot of recent short seller reports that have come out surrounding the company, where it's basically a fantasy and that the projections are just not possible, primarily due to, again, the scandium supply shortages. So another red flag is that the company's actually had 4 finance chiefs since the start of 2024, and then 5 if you include 2020. And then there's also 2020 Hindenburg short report, which actually triggered a financial restatement because if there's some issues with the accounting recognition within the 2020 accounts, and they actually had to restate the financial statements because it was actually found to have some misstatements. And then on top of that, the way they talk about the scandium issue, where they just outright deny it, which just again doesn't make sense, because if you look into the numbers, they clearly do have a reliance on China and their scandium, because otherwise how would they source any of it, given the fact that China has a monopoly on the rare earth material. So I won't go into trade thesis straight away, we'll come on to that at the end. But effectively, what then, when you're analysing Bloom for yourself, and especially like again the short reports that have come out recently, is you kind of want to break it down claim by claim, critically analyse them, and then come to conclusions yourself. So obviously the biggest claim being the no China supply chain for scandium. This is clearly false in my opinion. Again, if you just look at the data and look at the evidence, and one of the largest suppliers of scandium themselves, so Hunan Oriental Scandium, they themselves have literally admitted that they are BE's, so Bloom Energy's largest supplier, but it's not exported directly. And so that's how I think Bloom Energy are kind of getting away, I guess, from a legalese speak, is because I think what's happening is they're using intermediary companies in other countries like Korea, Thailand, I think Vietnam I saw as well. So you can't see I mentioned it here, where Chinese scandium is flowing via Thailand, Japan and Korea. And I think that's how they're getting away with, I guess, the legalese speak, that they don't have any China supply chains. But it's kind of a technicality, because obviously it's still being sourced from China, who are the ones that are actually sourcing the product and then refining it to then actually sell on as a finalized or finished commodity. That being said, I wouldn't say it's thesis breaking, because again, if anyone who's looked into this company already pretty much knows this, they know they have to utilize China. That in itself is not thesis breaking as a long position, but it just massively adds risk, because again, with the whole tariff war and trade war between US China, at any moment technically China can import an export ban on the material, which would be a massive detriment to the company and the business if they're no longer able to supply the material. So there's a huge risk factor that I think they're trying to negate, and that's potentially, as you'll see in the fair value target and in the fair value price target analysis, isn't really being factored into the stock's price. At the moment, the stock's trading as if there's pretty much no downside risk. They're pretty much going to achieve their goals by 2030. And then, of course, the other issue with this is, again, a massive red flag, where if they're lying about this, what else could the company be lying about? The next big point then is effectively the mathematics around the scandium production and getting to 5 gigawatts of power. To achieve 5 gigawatts of power, you need around 220 tons of scandium oxide. The projected global supply is 240 tons, and then the global demand for scandium is 310 tons. So a significant disconnect between demand and global supply already. And the fact, as I've said already, the stock's price is kind of already trading as if they've achieved this 5 gigawatts ramp up, which opens them up for some significant downside. The next point here is about demand being circular. I personally don't think it's too much of an issue, because again, it's a joint venture that Bloom have with Brookfields. You can kind of read it in your own time. Again, either read a short report or grab this analysis down below in the description. Kind of read and read up on all of this in your own time. Don't really want to make this a massive part of the video, just because again there'll be too much going on. Again, we'll come on to the final verdict and analysis at the end. Won't go too much in sector analysis, as I mentioned. Just highlighting, as you'd expect, in some of the forward valuation multiples, both for earnings and sales, of course, is higher than the peer average and then core competitors. You then have some fuel cell pure play companies, some data center infrastructure companies, and then the main power producers. But yeah, as you'd expect, it's of course higher multiples than all of them. That being said, the company does actually have lower PEG ratio than all of the sector averages, which of course reflects the incredible growth they're projected to have, at least in the near term. 100% earnings growth, 85% revenue growth, far exceeding any of the averages between any of the sectors. But yeah, I guess one of the good things about things like the PEG ratio is it kind of justifies, usually if a company does have a high valuation multiple, If you look at the PEG ratio, you can then kind of see why. Because yeah, again, the company has insane growth projected. When you factor that in, you could argue it might be actually relatively fair valued or even cheap compared to other power producers, more established power producers at least, or even the more speculative companies who still have a 1+ PEG ratio. In terms of SWOT analysis, we usually like to do then, of course, strengths, weaknesses, opportunities, and threats. In terms of strengths, we pretty much mentioned it, but the main thing is the time to power moat. If I just zoom in here, main bull thesis for this company, which of course is linked to the AI data center build out, which is then inflecting its P&L and giving it the insane projected earnings and revenue growth. Whether or not you think that's legitimate and you think that's going to continue is a whole nother argument, and would then be, of course, the bear case thesis. But there is extreme customer concentration. So again, if you're bearish on the AI data center build out in itself, you of course will then be bearish on this company. The next point being the Scandium single point of failure, which again we kind of beaten to death at this point. Cover the marketed, again 20 billion backlog, again another massive red flag, along with the other governance red flags of having 4 CFOs within literally 2 years, and having a previous history then of having financial restatements. And another good point to mention again is the valuation, currently at around $200-300 a share, leaves very, very little room for error and kind of poor risk to reward at the moment. However, again, if they're able to kind of bat away a few of these weaknesses and threats, then you could argue the stock is maybe still undervalued. In terms of opportunities, then again, the biggest one is the AI data center super cycle we're in. Incredible capex spend. Even if you don't believe in AI and you think the LLM models will cap out and AGI will not be achieved anytime soon, what is undeniable is the capex spend by the likes of Amazon, Google, Microsoft, all these massive companies. And so unless you see them kind of halting back on the capex spend maybe in a couple of years or maybe even next year, I don't really see that happening, but there's a possibility that they completely halt that spending. And if they do, then of course companies like Bloom will be largely and badly affected. And then again, another underrated point is the efficiency gains or scandium thrifting that Bloom can enable in terms of sourcing scandium in other sources. There's still that 10-20% outside of China, but also again, there may be other ways they can source the scandium. Biggest threats then, for me, it's one thing to point out, which we'll get onto the catalyst analysis, is the 10th of November 2026, because of course China suspended their export controls with their trade war with the US. But on the 10th of November 2026, that suspension technically will become lifted, unless again they either delay it or then come to a nice conclusion and basically end the trade war, which I'm not sure will happen. I think we're more likely to maybe see an extension of this deadline, but at the moment the deadline is the 10th of November 2026, and after that date, unless nothing changes, there will be export controls on scandium, which will be a massive threat to Bloom and their business. Some other couple of points, again, you can kind of read in your own time, but nothing too important. Wall Street Insights, always I like to get a gauge on what the market thinks. As you'd expect, there's a massive divergence between the bears and the bulls. Given the volatility of the stock, it's reflected in the price and how much on a day-to-day basis the stock price is changing. There's a clear disconnect between the bears and the bulls, much more so than normal. And for me, that usually what that reflects is a market that just is not confident either way on where this company lies. There's a lot of red flags and a lot of uncertainty around in the stock. Also have a catalyst calendar then in terms of the next major dates to look out for in the upcoming future, especially over the next few months. So in terms of some binary events, which means either bearish or bullish dependent on the actual outcome of the event. But yeah, we have the Q2 earnings call on 28th of July. The next one is more of a counterparty risk, so AEP. They have their Q2 earnings call. And this is a point we haven't talked too much about, so I won't kind of confuse you right now, but again, if you get the document for yourself, you'll be able to read up on that more in depth. Similar to the New Mexico air permit, we've not really touched upon that, but that's linked to the Oracle Project Jupiter. Similar to the Q2, then you have Q3 in late October 2026. Effectively the same thing happening here. But for me, I just want to highlight the two big catalyst coming up, which was again the 10th of November, which I mentioned with the export controls. The suspension will lift on this day unless something happens, something changes. It's also worth mentioning this export control does include the de minimis rule of reaching third country intermediaries, so like Thailand, Japan, Korea, where they sell to those companies and then those companies sell to the US, that kind of loophole will be banned as well and will be clamped down upon. And it's probably the only real catalyst and hard dated catalyst that we have for the stock. If you do want to play any options contracts and you are leaning bearish, then this is probably a good date to play your options contracts around. In terms of expiry dates, is around the 10th of November. Technical analysis then, don't want to go too much into this. Usually I keep my technical analysis, as always, very basic. Just like to look at the more support and resistance numbers. But in terms of resistance then, we're likely to see around 320 and 350. But to be fair, the stock's like pumped up so much, there's no real resistance levels, I don't believe. More just psychological ones. And then support, we see the main psychological support really at $200 a share, which it bounced off of just recently. Breaks that, we'll definitely see a gap down, I think, to about 170, 120, in between this range again. In terms of the fair value price targets then, given how volatile and how much uncertainty is around the stock, I've kind of done a different to how I usually do. If you watch any of my other videos, you'll see I'm more, I guess, certain in terms of like a thesis, and then this is likely to be what I would value this company at. With Bloom Energy, it's just, again, too many variables, too much uncertainty. And so I found the best way to do it is by doing a probability weighted scenario valuation between the base case, bull case, and then bear case. So for the base case, I'll value the company based on having a 0.6 peg ratio. And the reason for that is because the established players in this segment are the power producers, and they have then an average peg ratio of around 0.6. Given it's a growth company, we'd want to ideally value the company on its growth rather than current sales or even forward sales or forward earnings. So that's why I used a peg multiple in this instance, which I rarely use. Using a reasonable peg or 0.6, which I think is still cheap. Anything under a 1 is really cheap, is technically cheap, to be honest, because then it implies that the growth is larger than the PE ratio. Given a peg ratio then of 0.6 and using a pretty high discount rate, to be honest, 21%, on the FY27 EPS of $4.55, returns then a share price of around $246. So of course, as of the 17th of July, the stock was trading around $215. So some decent upside in even the base case, to be fair. If management are lying, given all the red flags, you then want to backdate the valuation to the sales. As always, you want to be as prudent as possible. Given the fact that the company is loss-making, you don't want to value the company at all on anything related to earnings, and that's when we fall back to then the valuation based on revenue and sales. Being as prudent as possible, then in the bear case scenario, we'd want to value it as like a standard power producer, a power company. And the average there is then again a 3.2x multiple based on forward EV to sales. If we were to assign then the FY26 coming up year sales projected of 3.75 billion, I've given it. I think management are predicting anywhere between 3.5 to 3.8 billion. So definitely still on the higher end, to be fair. But if you give them a 3.2x sales multiple on the projected sales this year of 3.75 billion, you get a stock price of $42. I think that probably is the biggest indicator of just how volatile this stock is. The bull thesis then, it's kind of what brought me onto the stock over a year ago now, by someone called Jianshu Dong, who discovered the stock last year in September 2025, before a lot of people did. Back then the stock was trading around $67 a share. And yeah, it's just basically his blue sky, pie in the sky valuation for the company, 10-year upside case of $2,000. Very, very simple how he came up to that figure, to be fair. You can kind of pause the screen, read it here, or I'll link the analysis in the description. But yeah, very, very simple how you come up with it. But again, it kind of does make sense, where he's just basically using comparative sectors and segments in the energy, I guess, overall industry. But discounting that 2000, I guess, projected share price by 2035 by a fairly, again, high discount rate of 21%, given the company's insane beta of 3.81, gives then a present value stock price of around $360 a share, which again does reflect pretty good upside, especially from the current price of 215. If you actually look at the all-time high, I believe it was $351. So the company, so the stock price basically touched the all-time high, basically touched the present value of this pie in the sky valuation. So that's why I personally think it's reasonable as a bull case scenario. Obviously, I've already given it a probability weighting of 20%. But yeah, I do think it's reasonable because the stock price itself has pretty much at one point anyway, when it was at its most exuberant level, reflected that ultimate bull case thesis of being $2,000 a share by 2035. And again, we've discounted that back to present value. If you add up all the weighted prices, then we get a fair value price target of $187. So roughly around 13% downside to the current stock price. But relatively, I guess, it indicates the stock is fairly valued. So what does all that mean then? For me personally, it's just super inconclusive. Typically, I like to trade stocks based on fundamentals and the underlying catalysts. In terms of catalyst, the only one I can really see is the 10th of November with the more macro side of things in terms of export controls with China and the scandium. But on a micro level, there's no real upcoming catalyst that is material other than, of course, earnings calls, which, of course, are always material. Kind of made the point here in the final conclusion then with the main trade thesis. Given the fact that the scandium commodity is the main influence in the stock, I'm not a commodity expert for one. In terms of the efficiency gains and the thrifting and supply chains around scandium, again, I'm not an expert. And even people who are experts, they still effectively have stated that there's not enough data and Bloom Energy haven't given enough, I guess, information to effectively be able to analyze conclusively whether or not they're able to achieve 5 gigawatts of energy, whether or not a China export ban will actually really hurt them or if there'll be ways around it. There's basically too much uncertainty, and even experts surrounding, again, this rare earth material, they're effectively unsure. I definitely then can admit when something is outside my circle of competence. Given how volatile the stock is, I do think even for someone such as myself who maybe can't trade the fundamentals this time, you can potentially trade just the volatility of the stock, right? So if we go back onto technical analysis, you can kind of see here within just, if I zoom in, within just the past year, so at the beginning of the year, the stock was trading around $120 a share. It then peaked at $350 a share, it's come back to $200 a share. Even within months, you can see just the level of volatility and how much the stock price moves. And so I think those kind of quite aggressive movements could just lead to at least potentially short-term trades, just effectively trading around what I believe is a fair value price target then of $187. So for instance, if the stock price was to bounce back all the way back up to around 350, 300 plus again, but nothing fundamental has changed in terms of, and there's still uncertainty around some of the red flags that we've mentioned, then I potentially would open up a short position in the company. I wouldn't short the underlying stock. I'd definitely use options contracts and buy puts just to cap my downside. Again, with something this volatile, you definitely don't want to be, naked shorting anything. But then what I potentially would do, again, if the stock price from now, say, was to go above 300, I might buy some November, December expiries and effectively play the macro catalyst of the potential export control issue. I think at that point the risk to reward is in your favor because, again, as I mentioned, like the best case scenario for the stock is, again, they achieve $2,000 per share in 2035. You get a present value, that's around $360. So if the stock price was to get near this price again, then it's effectively priced to perfection. But if the underlying red flags haven't been cleared, then there's a significant disconnect between the stock price and the fundamentals, and that then gives you potentially an arbitrage to trade and short the company. Vice versa then, if the stock price was to crash and continue to crater, potentially go down to 140 and below, but then again, the fundamentals in terms of AI supercycle capex spend haven't changed, or even better yet, the scandium issue has been either completely rebutted and there's been evidence and you gain more comfort over that, then a potential either long-term investment opens up, or again a long trade using options contracts potentially opens up. So effectively what I'd say is you can kind of play the stock's price here and the volatility, with the base being around $188, around $200 a share, which of course the company is currently trading at. So at the moment it's kind of fairly valued, I'd say. But yeah, I think I'll leave the video there. Kind of went on way longer than I wanted to, or we'll probably edit the video up and splice a lot of it out. But yeah, I'll leave it there, and then yeah, until next time.